Howdy, Jacob here. Today we're looking at UGI Corporation. We see that they have a $4.6 billion market cap on $10.9 billion enterprise value. Not good start to see enterprise value that high. Net debt is very positive. 6.79% dividend yield. It looks like they have paid out a dividend every year for the past 10 years, and it's gone up at least 3% a year, year over year, as high as 14.4%. Return on invested capital, 5 year average basis, probably mid single digits. So nothing to brag back to mom about. Balance sheet, 6.5 billion in long-term debt, 706 million in short-term debt, and only 240 million cash and cash equivalents. So the liquidity on their balance sheet is not very attractive in comparison to their heavy interest bearing debt. We see that um, their capital expenditures have grown quite a bit from 457 million 10 years ago to 974 million in 2023, and their cash from operations is not up at that rate. And we can see that their funding for acquisitions and dividends has very consistently been through debt. We see 2 years of the last 10 years of debt repayments. Otherwise, we just see issuance, issuance, issuance. 5 year average free cash flow is about a little over 300 million, and we see that their aggregate dividend payout is $308 million, and so we're going to have to cut that in half for sure, because then we're seeing about 50% payout, a little less than 50% payout. And then hopefully we want to see this company pay down some of that debt that they have to where they're not in a great position on the liquidity side. And then also making just $300 million a year, roughly on a 5 year average basis. That's over 20 times their 5 year free cash flow to get to long term debt. And so not looking like a great position there. As for the other assumptions, I feel like 3%, 13 on a P price to free cash flow. Don't need to do too much emphasis there. We'll do 7, 6, 0%. How did I? I mean, it's saying it's pretty close right now. I think I know why. Okay, so balance sheet, $6.5 billion, inclusive of short-term debt. Let's say $7 billion roughly. You increase their rate 2%, you're looking at about $140 million. 140 million compares to a little over 300 is going to be cut in half, and so I'll take almost this cut in half. So let's do 3.5. That is why. So what I did there was literally just looked at a 5 year average of margin and then said, what would a 2% hit on their 2% increase on their interest rates due to their margins? And it cut it almost in half, saying that about $140 million increase in payment to debt, and their 5 year average free cash flow was just over $300 million. And so, pretty big hit on margins there. And so that's why I cut them down quite a bit. But that gets us to a stock price that needs to fall 40% before we get a 15% return, given these assumptions. To me, I hate companies that I see a lot of debt in, and I see no form of caring, and I see no debt repayments, no consistent repayments to where they're actually focusing on deleveraging their balance sheet, and it's just not the most attractive thing to me, and it always scares me to invest in a company that has so much debt and doesn't really care about it, since lenders can absolutely come after you and say, hey, we need this money back now, and if they don't have the liquidity on their balance sheet and they can't produce it through a very quick amount of free cash flow or selling off or free cash flow, then they're going to have to sell off assets for very likely not necessarily pennies on the dollar, but could be 60 cents or 50 cents on the dollar, which is also very unattractive. And so, for me right now, just waiting. Hopefully, everyone enjoyed the video and has a great day. Thanks.